With the market neutral strategy, what we do is we write weekly covered calls on both bullish and bearish ETFs for the same index, which can allow you to profit if the market goes up or down. So, for example, you could buy or you could write a covered call on the bullish small cap index and at the same time write a covered call on the bearish small cap index. So the idea is to be on both sides of the market, and you can profit if the market goes up or down. And now these are covered calls, so this is different than the super portfolio. These are actually covered calls, and these can be traded in most retirement accounts. This is less risk because you actually own the underlying stock or ETF. When you're selling the call option, you actually own the underlying ETF. So these are covered calls and incur less risk than the super portfolio. And then if you write these covered calls on using weekly options, then again you get that opportunity to sell premium 52 times a year. So the premium you collect on these covered calls can be substantial. And I roll over the weekly options each week, like I do with the super portfolio. On Thursday or Friday, I'll close out the option that's expiring, and then I'll send the next weekly call option. So today you'd be closing out the July 21st calls, and you'd be selling the July 27th weekly call to roll over this week. Now, with these market neutral spreads, I'm collecting 2 to 4% or more in option time premium per week for both the bullish and the bearish covered calls. And as we mentioned previously, that time premium, that 2 or 4% that I collect, becomes profit at option expiration regardless of the price movement of the underlying ETF. So that's the main reason this strategy does so well is you're selling time premium, and you profit from that at option expiration regardless of the price movement of the underlying ETF. And I write these covered calls on leveraged ETFs, and with a leveraged ETF, of course, the premium's higher. So writing these covered calls on leveraged ETFs can lead to a 200% cash-on-cash return over the period of a year, regardless of the price movement of the underlying ETF. And here's an example. This is the TZA. This is the short small cap ETF, and I sold the 21 strike call at 115. Now that worked out to be a 5.4% weekly premium. So if you did that every week, you're talking over 200% cash-on-cash return over the course of a year. Of course, these leveraged ETFs are more volatile, but you can collect a lot of time premium with these. And even if the underlying index goes against you, collecting this cash-on-cash return, you can still be profitable, even if the underlying ETF moves against you substantially. So here's an example. The TZA was trading at 21.84. I sold 36 of these 22 strike calls at 122, and that worked out to a 5.5% weekly time premium. So, and for these 36 calls that I sold, I received $4,356 in cash into my brokerage account after commissions. So if I did that 52 weeks a year, collected a similar premium, you're talking over 200% cash on cash return just by selling these calls each week. So when you're collecting that much time premium each week, a lot can go wrong with the trade, and you'd still be profitable. You'd be profitable even if you had bad timing and when you entered the trade, and that's the timing of when you enter is usually not a factor, because with these market neutral spreads, you're on both sides of the market. And the volatile price swings that we have allows me to take profits as early as Monday or Tuesday on these weekly covered calls, market neutral covered calls. So what I like to do is I put an order in as soon as I enter the covered call. I'll put an order in to close out that short call if it reaches 85% of the profit potential, and that way I can exit the short call as early as Monday or Tuesday if we have volatile price swings. And if you're collecting this 2 to 4% per week in time premium, you can be profitable even if the underlying ETF declines in price. You can still be profitable if you're collecting a 200% cash on cash return. And here's one of the reasons why these weekly options are so much more lucrative when you're selling premium. Here's a snapshot I took of MasterCard when it was trading at 457, and I took this is a snapshot of a auction chain here, and you can see the May 4th weekly option. It only had 4 days to expiration, but you could have gotten, if you sold it at the market and sold it at the bid price, you would have gotten $11.90 in premium. And at the same time, if you had sold the July monthly option, same strike price, 460 strike, which would have been the at the money call with MasterCard trading at 457. So if you sold the July options, which expired in a couple months, you'd collect 23.5 points of premium. So over this same time period, you could have sold 12 of these weekly options at $11.90 and got 142 points of premium versus the 23 points by selling the monthly option. So that's why these weeklies are so lucrative, because in this example, you could collect up to 142 points of premium versus 23 points over the same time period. Here's another example for AIG, and in this example, the weekly, you could sell that at 71 cents, and the monthlies, the August monthlies, you could have sold at 239. So you're going to have 16 of these weeklies, which adds up to over 11 points versus 2.39 points of premium for selling the monthly option over the same time period. So that's why these weeklies are so lucrative. And with these market neutral spreads, because you're positioned on both sides of the market, the market neutral covered calls, they work best when the underlying index is flat for the week. And the losses occur on these market neutral spreads when the underlying index makes a large move in either direction, because remember, you're on both sides here. So a large move either up or down can cause these to lose money, and the best scenario is if the index is just flat for the week. So what I like to do with these market neutral spreads, because you can lose money if the underlying index moves either up or down, I like to sell out of the money calls in puts, and that way the index, the underlying index, can move quite a bit, maybe 6 or 7% before you start losing money. So with these, I found that it's better to sell out of the money calls and give that index some room to move before you start losing money on one side. And what I did is I use historical data to select these out-of-the-money strike prices. So if you use out-of-the-money strikes, you can profit even if the underlying index, even if it rallies or declines 8 to 10% for the week. So that gives you some room with these by selling out-of-the-money options. And for example, if an index on average, if it moves 6% on average per week, then I'll sell an option that is 6%. I'll sell an out-of-the-money option that's out 6% from the price of the index. So this would allow me to profit if the index moves up or down 6% that week. So with this, using this historical data, I'm about 80% accurate on these market neutral spreads. And here's the other part of these market neutral spreads that can make them even more profitable. As I mentioned, if you use a profit target to close out the short call option at 85% of their profit potential, this can increase the accuracy. So let's say you sold a call option at 2 points, and as soon as I enter that covered call, I'd enter a good till canceled closeout trade to close out that 2-point premium, short premium, at 0.30 points, which is about 15% of your entry price. So in other words, you've reached 85% of the profit potential. You might as well just close it out in case that particular ETF comes back. And so if you close it out at 85% of the profit potential, a lot of times, like I say, I'll be able to exit these trades on Monday or Tuesday. And
Chuck, you use that for a parameter just due to the fact that the risk to reward ratio at that extra 15% just isn't there?
Yeah, that's it exactly. You don't want to risk giving that back. So if it gets to 85%, I'm out. And I just have a good till cancel order there. I'll wake up, I'll look at my computer screen and say, oh, I just closed out my short calls today, and you know, it's better to close them out, I found, because like you say, the risk reward just isn't there. So to collect that extra 15% is not worth it in case the underlying ETF comes back, and then you could actually incur a loss on the trade. So I'll just simply enter that GTC order. I wake up, I'm out of the position, and then I wait for the next Thursday or Friday, and then I sell another premium. So here's an example. June 1st through June 8th was the biggest rally of the year, and on average, the market neutral indexes I was trading had rallied 11.4% that week. That was June 1st through June 8th. Now that normally would result in, if it moved up 11.4%, that would have resulted in a loss on the bearish ETFs. But the market had moved down earlier in the week, and I was able to close out the bearish covered calls, and that prevented a loss for the week. And that week, using these profit targets at 85% of the profit potential, it gave me 91% accuracy, and it produced $26,000 in net profits after commissions for that week. So Normally, 11.4% rally would have caused a loss in the short covered calls, but because I had already closed those out earlier in the week, I had a profit on the short ETF covered calls, and I had a profit on the long ETF covered calls. And here's, I think I only had one. Yeah, I had one loss that week. So I had, in this particular account, I had a $16,000 profit after commission, and in this account I had a $10,000 profit. And this was for the June 8th weekly covered calls. And again, the indexes I trade were up over 11%, but I still had a $26,000 profit, and I only had one losing trade because I exited it at that 85% profit target. Here's another snapshot. These are the June 16th weekly options, and I had, in this account, I had a $11,000 profit after commissions. And here's another one. This is the June 22nd weekly options, and I had a $16,000 profit that week. And these are all closed trade profits after commissions that I'm showing you here. So let's look at one more of these spread strategies that's been doing well, the covered calls. And again, with the covered calls, there's a lot more opportunity for success if you trade these weekly covered calls, because you're selling this time premium every week. So just like the super portfolio and the market neutral, you know, the fact that they created these weekly call options back in 2010 dramatically increased your profit potential for these spread trades, because you're selling premium every week. And here's an example. This is a covered call on the small cap ETF, and I bought to close the 46 strike calls, sold to open the 49 strike calls at 147. And I used an option spread order to close out the expiring options, and then to sell to open the new weekly option, and that allows me to save on commissions and also on the bid-ask spread. So so at the time I sold these 49 strike calls, the small cap ETF was trading at 48.88. So this was an out of the money call. Sold it at 147, and I collected a total of $2,628 for selling 18 of these 49 strike calls. So again, if you and here's the other thing I wanted to point out. The reason I use the spread order is I just own this the TNA ETF, and I just hold that in my account, and then I roll over each week, each Thursday or Friday. I'll roll over the calls, and I just keep the ETF stock in my account. So I use these rollovers each week. And if you were to initiate a new covered call with the TNA trading at 48.88 minus the 147 you received in the option premium. So if you were trading 100 shares of TNA and you sold this call, you'd have a total investment of $4,741. So this time premium here, of course, is profit at expiration, and because this was all time premium, it was out of the money call, I'll collect $147 in time premium, regardless of the price move of underlying ETF. And So again, that's time premium you're selling, and if you multiply that out, and you were able to do that 52 times a year, I collect approximately $7,600 in time value profit versus my $4,700 investment. So again, this works out to you have the potential to collect over 160% cash-on-cash yearly return by selling an option on this TNA each week. So same principle. You can collect a lot of time premium over the course of a year, and when you're collecting that much premium, you can still profit if you have bad timing when you enter the trade, if there's volatile price swings, and even if the underlying stock or the ETF declines substantially. You know, when you're selling 160% cash-on-cash return, then a lot of things can go wrong, and this trade will still be profitable. So here's a snapshot. A time premium I sold 1 week. This week I sold $16,000. Here's the cash here that was credited to my brokerage account, and here's the options I sold. This week I sold $28,000 in premium, and again, it's listed in the right-hand column here, and that was selling weekly options. So this can really add up over the course of a year. So and here's an example of rollover trades that I use, because again, I just hold the underlying stock or ETF in my account, and then I'll put an option spread order in to close out the expiring option and to sell to open the new option. And I like to use these spread orders to roll over at expiration. And here's a snapshot of my weekly covered call portfolio. I trade this in 2 accounts, and this had a $332,000 open trade profit, 36% return when I took the snapshot. Here's the second account, and here's a snapshot of last year, March of 2011. I was trading these weekly covered calls, and this snapshot shows in this account I had $323,000 open trades, average return of 54%. So that's a pretty good return for such a low risk strategy. These covered calls, 54%. And this was last year. So I was trading the weekly covered calls last year. And this is a snapshot of my 2009 trading contest, and I placed first that year with an annual return of 122%. And at that time, they didn't have weekly options, but I was trading monthly option covered calls, and I was simply rolling over my covered calls each month, and that allowed me to compound my return. So in this account, I had a 122% return for the year trading covered calls. So, well, that concludes my presentation for today, and I'd be glad to take any questions if anybody has any questions about what we discussed today.
Sure. Chuck, based on people getting involved in cover calls and getting exposure to them, getting their toes wet, what would you say is the bare minimum account size that someone could really start to get active in this type of strategy?
Yeah, I would say with the covered calls, probably a $15,000 account would be well worthwhile. And if you had a $15,000 account, you could probably do 3 covered call trades a week, and that way you could diversify a little bit and collect 3 premiums each week. So I'd say about a $15,000 account.
Okay. I know we have a lot of questions out there. The screenshot that Chuck has up there now is to contact Brad. Brad is, he leads his support group, and these guys are pretty good at addressing questions. Many of the questions that we have here today are regarding, how much your services cost and stuff. That's not something that we can address here, but feel free to contact Brad, and he can give you all the ins and outs.